Well, stock markets around the world are starting the month on a high, on a record-breaking high, in fact. US investors got the ball rolling by scaling new heights at Thursday's close. And on Friday, Germany followed its lead to reach its highest level ever. The benchmark is now up about 7% since the start of the year. Now, Japan's Nikkei continued its upward climb, ending the session nearly 2% higher. The Nikkei has now notched up gains of almost 20% so far this year. And Australia's main index scaled new heights, closing just over 0.5% higher there. Let's speak now to Marc Ostwald, Chief Economist and Global Strategist with ADM Investor Services International. Welcome back to the programme, Marc. Good to see you. So the inflation figures aren't quite what economists were expecting. What's your take on that?
No, they weren't. And basically, if you break it down, what you've got is a little bit of a counterbalance between the deceleration in falling energy prices and a still rapid fall in food prices. I mean, last month, the food inflation number was 5.6. We're already down to 4% this month. But what the ECB will be worried about, and has basically made this point time and time again, is services inflation remains stubbornly high. It was a little bit lower than last month, but it was up, at 3.9% year on year, but it was up 0.8% on the month. And there's really been little change in the annual rate of services inflation. And that's probably indicative that there is still quite a, there's quite a lot of pressure on wages in the services sector. And that's exactly what the ECB is being why it's being cautious on basically looking, for the first rate cut. It is a problem. It's not just a problem in the Eurozone. It's a problem in the UK. You see it also in the US and Canada. So it's a pretty much universal problem.
A universal problem. What's the main reason, do you think, though, that prices are staying so stubbornly high?
Well, in services terms, it's basically that, if we look at the fall in prices in for the power sector for Europe, which has been, they've come down a very, very long way. However, for most companies, they're actually still double what they were pre-pandemic. And factoring that in, when a lot of other input costs are, when inflation decelerates, what you have to remember is your cost base has still gone up. And this is where the problem lies, and it's gone up not only for you as a business, but also for consumers. And that's really where the problem lies, because they will then want compensation in their pay packages. And that's what we're basically seeing. This is a so-called second round effect, which will take time to iron out.
So I was just talking about how high the markets are at the moment. What's the reason for that? Is it because a Fed rate cut in June is still being baked in? And, do you think that's going to happen? And what's going to happen in Europe in terms of rate cuts?
Well, I mean, I find it remarkable that you had that summary beforehand, and you mentioned German DAX getting a new all-time high and the Nikkei at an all-time high, and both economies are in recession, or at least in technical recession. The US obviously in a very different place. I think there is, to some extent, it's very narrow because it's very focused on the tech sector and all the fantasy that, the hope that is carried on the back of the AI wave. In part, it's because central bank balance sheets actually haven't been contracting now for about 3 or 4 months, whereas they were for most of last year. And that, quantitative easing money basically just continues to get spun around the financial sector. So it's not necessarily the financial economy and the real economy are becoming ever more divorced.
OK, Marc, always great to get your thoughts. Thank you so much. That's Marc Ostwald, Chief Economist and Global Strategist with ADM Investor Services International. Thanks a lot.